Welcome Mr. Sam Quawasmi to the stage. He's the co-CEO and co-founder of Eureeca. I'd like to welcome Mr. Robin Newnham to the stage. He's the head of policy analysis and capacity building at the Alliance for Financial Inclusion. And I'd like to welcome Isvary Sivalingam to the stage as well. She's a senior manager of MicroSave. We'll have a panel on financial technology and harnessing techies for good. Is this working? All right, can everybody hear me? Wonderful. So we have a rather distinguished set of professionals, all active in financial technology and in financial inclusion. If you all could introduce yourselves, maybe starting with you, Isvary.
Very good morning to everyone here. My name is Isvary Sivalingam. I'm here representing my organization, MicroSave, and we're an international consulting firm that's very much focused on financial inclusion, which means that we've spent the last 20 years working across Asia and Africa. And we are large proponents of, market-led solutions because that's the only way to achieve sustainability, especially in developing markets, but also customer-driven solutions. So a lot of what we do is built on what the low-income customer needs, and it's targeting how to help institutions that address the needs of low-income customers.
Good morning, ladies and gentlemen. My name is Robin Newnham. I'm representing the Alliance for Financial Inclusion. AFI is a membership network of central banks and financial regulators from across the developing and emerging world. We have 120 member institutions from more than 90 countries, and collectively those countries represent more than 85% of the world's unbanked population. So we're looking at the developing and emerging world, right down from the poorest, least developed countries up to the BRIC economies. We are headquartered in this building in Sasana-Kijang, so I had the shortest trip of all the panelists. We are primarily supporting our members through providing knowledge exchange, peer learning platforms on technical aspects of financial inclusion, but also, very importantly, provide a platform where members can make public commitments and goals and establish national financial inclusion strategies. In relation to this specific topic, I'm very glad to be invited. Many people do not normally associate the regulator with innovation. In fact, regulators are often perceived as being a hindrance or bastions of conservatism. But I think what we're seeing amongst our membership is that there are a number of central banks that have really now taken financial inclusion into their mandate and have embraced the need for enabling environments for innovative technology. So I hope to go into that a little bit more later. Thank you.
Hello, my name is Sam Quawasmi. I'm the co-founder and co-CEO of Eureeca.com. Eureeca.com is an equity crowdfunding platform. What equity crowdfunding is, you're probably all not very familiar with the concept, is we allow businesses to raise expansion capital through the power of the crowd. What I mean by the crowd is that people like you and I can now participate and own shares in growing businesses. We launched out of Eureeca launched out of Dubai about 2 years ago. We're the first equity crowdfunding platform to cross borders. So we cross borders into Jordan, Lebanon, Egypt, Kuwait. Recently, we got regulated by the UK's Financial Conduct Authority. That enabled us to set up shop in the UK. So we raise money for UK businesses as well. But also, we recently got regulated by the Malaysian SC. So that's why I'm here to set up our our hub here in order for us to expand to Southeast Asia.
Hi, I'm Jason Best. It's great to be back in Malaysia. I'm based in San Francisco, but the firm that I started, Crowdfund Capital Advisors, was started in 2010. We create, basically work with ecosystems and countries to create crowdfunding for equity and debt markets in countries around the world. We've worked in 36 countries. My background is actually as a tech entrepreneur who's raised capital through the conventional means of private equity and angel investing and VC. But then back during the financial crisis, we created we felt there was a need to update securities laws in the US to enable equity and debt crowdfunding to take place. And so we created a regulatory framework and lobbied for its passage in the US, which happened in 2012. And then have been working with a number of regulators, financial institutions like banks, technology innovators like Eureeca, and others to create these opportunities for better financial inclusion and better access to finance for SMEs, and to enable startups that are so important for job creation and innovation in a country to have better access to capital as well.
Thank you all so much. There's quite a lot going on in this field today, and there are many barriers, often cited barriers, to greater financial inclusion and to greater implementation of technology. In your opinion, panelists, what are the most significant barriers? Is it not enough or not good enough technology? Is it a lack of financial literacy that stops people from accessing the financial system and also accessing technological tools that might help them to be more active? Or is it a regulatory issue primarily? That's a broad question, but please make your answers a bit more specific.
Sure. So, well, I think it's all of the things that you mentioned and some more on top of that as well. I think, first off, we have to be realistic that although we can see a huge potential of financial technology to reach bottom of the pyramid customers, the vast majority of fintech is clearly targeted at well-off consumers in well-off countries. So first off, there's a challenge of sifting through the myriad innovations to see what actually has the potential and what could be deployed in less developed markets to have a real impact on people's lives. I think there's some basic infrastructure challenges in many countries. 20% of the world's population still don't have access to electricity. I think 12% don't have access to mobile phone coverage. So these things need tackling before you can start to talk about deploying fintech solutions. Product design is clearly very key. The product has to be usable and accessible to the consumer's needs. If you have a mobile money product where the consumer has to go through a dozen different steps just to check their balance or to make a transfer, it's very unlikely to be used correctly and to take off. If you look at the Kenya example with M-Pesa, one of the reasons it was so successful was because it mimicked a behavior amongst consumers that was already there. Even before there were e-money wallets, consumers were slicing up airtime and sending that to each other as forms of payment and remittances. And the mobile money product came along and built on that consumer behavior. It was very easy to understand. Clearly the price of services as well has to be brought down to a level that poorer consumers can afford. And then, of course, the regulatory environment, I think, is absolutely critical, especially when looking at an area with like digital financial services, where very complex issues of consumer protection, financial stability and integrity and competition come into play as well. We have seen a number of innovative regulators that have passed e-money regulations, creating a level playing field for providers, agent banking guidelines that have had a role, and proportionate KYC requirements as well are very important here. If you have, many people in developing countries do not have formal identification still. You have to deal with that. So the more we can automate the ID process, the client onboarding process, then that will help to make the technology accessible.
So yeah, I just want to follow up to Robin's comments, and he's very rightly pointed out that there are some basic things required. And once again, I focus on the low-income population or the poor who very often have a lot more difficulty accessing things that we take for granted, for example. So in order for financial services and products to really transition to a digital platform, you need basic connectivity sorted. And I've just come back from 6 months in the field in India, and very often, 3G wouldn't work. So it becomes a problem if, even if you have the option of sending a payment or making a payment using your mobile, operationally, there are issues. And interestingly, this is what we're seeing in a lot of markets. And there's a bit of, I don't mean to be a party pooper here. I'm all for technology, and I think the trends are very much upward trends based on the way mobile penetration and smartphone penetration is going. But there is still a bit of a paradox when we say mobile money, and I'll talk about the Asian context because that's what I'm most familiar with. So in Asia, we have 3 major players who have been considered very successful in implementing mobile money solutions, and this would be Wing in Cambodia, you have Easy Paisa in Pakistan, and of course Bcash in Bangladesh, which is probably the darling in Asia. But if you look at the types of transactions that are going on, a lot of this is still very much over-the-counter transactions. And what does this mean? It means that it doesn't actually mean that the poor person or the customer puts in money into his own e-wallet and makes the transaction independently. He relies on an agent who then uses his own mobile phone to make the transaction on behalf of the customer. You might say that these are, and they could very well be teething issues, because people need to understand how to use technology, and I think there's still some barriers because there's fear of using apps and mobile phones for many people in this segment of the customer base. But this also results in certain issues because it then puts a lot of power in the hands of agents, for example, who then, what they do is they can charge unofficial commissions, and they might select mobile money providers who offer them better commissions. So they would do it in a way that favors them. It doesn't necessarily protect the consumer's interests. So there are some issues, and I see it as something that could change as more and more people have the capacity and have the confidence of transacting directly on a mobile phone. But I think where we're at, particularly for the low-income segment in developing countries in Asia, is that a lot of this is still agent-based. So that's sort of my observation on where the mobile money market is in Asia, and it's sort of directly linked to the challenges of using technology today.
So more of an infrastructure issue then?
Yeah, but also just familiarity issue. So if people don't understand how to use the product, and the other issue is that if it's too difficult for them to use the product, because you might try 5 times to make a transaction, but because of your bad 3G, it doesn't go through. They give up and pay a little bit more to go to the agent and say, "Can you help me out?" Because it saves me a lot of time, and for poor people, we all know that they work pretty much most of the day. So every hour or every minute that they spend on this is actually time taken from some other available opportunity to earn an income, for example.
Absolutely.
Yeah.
Jason and Sam, you all might have a different perspective on this since you're involved in crowdfunding.
Sure. I mean, I think first, when we work with governments and regulators and the ecosystem, I would just want to echo the comments that there are a number of very forward-thinking regulators and central bankers that we've met with in a number of countries who are looking for solutions, who are tired of the situation that they're dealing with and are looking for solutions to sort of break some of these cycles that countries have been in for a long time. Last week, I spent the week working with the Central Bank of Morocco and the Minister of Finance, the Minister of Industry and Trade in Morocco. And we're working on crowdfunding, and the governor of the central bank gave me explicit permission to say that he wants me to publicly say he's very pro crowdfunding. and really sees it as an opportunity to really advance SME development and entrepreneurship and innovation in the country. And one of the things we found helpful is that really, when it comes to making these decisions about how you want to regulate crowdfunding, how you want to enable this in a country, there are really 4 stakeholders you have to satisfy. And you're really balancing the needs of those 4 stakeholders against each other. Because if you create regulation in a lopsided way, one way or the other, what you end up with is a system that doesn't work. And so you've spent time and energy and a great deal of resources to create crowdfunding in a country, and yet the regulation doesn't allow that market to adequately form. And so the 4 stakeholders really are, number one, you have to protect investors, primary. And how do you do that in a way that makes sure that they are understanding what they're investing in and that they're adequately protected? What kind of disclosures and transparencies are available? 2, you have to make sure that companies can actually get access to the capital they need. By that, I mean, if you make the process too difficult for them, too much work for them to be able to access capital through these new technologies, then, as you mentioned before, they'll just quit because it's not worth the effort. Number 3, you have to provide transparency for the regulator and making sure that the regulator can utilize these tools because crowdfunding happens online. It's really simply taking a very ancient process of sharing capital among people who know each other, putting it online, using social media and the web to do that. And when you do that, you provide transparency that has never existed before. And so so that regulators can actually see the data on what's happening in the private capital markets in a more real-time way than was ever possible. And so how do you do that so that it doesn't overburden platforms that are operating in that market, but provides the transparency a regulator needs? 4th is making sure that the crowdfunding platforms, excuse me, and the crowdfunding ecosystem itself has enough oxygen to survive. They have to be able to make profit and be able to grow and be successful and thriving businesses. And so you want to make sure that they have that opportunity in a regulatory framework that doesn't overburden them as well.
Right, so challenges in emerging markets. Well, I'll tell you that's probably everything about Eureeca, right? I mean, we launched Eureeca in a frontier market, not quite an emerging market, but we venture out into emerging markets. And the challenges that we witness everywhere we go are probably threefold. But Jason and my colleagues here touched on the importance of regulation. I mean, it makes absolute sense, right? So just to give you a bit of a perspective, 60 to 70% of the jobs worldwide are created by the SME sector. 90% of any company hiring takes place after the company's been funded. And the number one reason why SMEs and startups fail is lack of access to capital. So do these guys go to the bank? Yeah, they absolutely do. Do banks lend to them? Absolutely not, right? So what's going to happen to these guys? They end up dying along the way. So that's why equity crowdfunding platforms just make absolute sense. But what are the challenges? What do we face every country we go to? Regulation, absolutely. Regulation for us is very important because it allows us to market our activities. It allows us to advertise. It allows us to educate the users. It allows us to make sure that people are aware of the product. For example, for us, we see entrepreneurs on a daily basis, and the number 2 challenge that we witness is education. They don't understand and they don't know how the process of capitalization works. They don't know that hang on a second, I can raise some money for my business right now and make my dream become a reality. I can own my own business. They don't know that, and we have to undertake a massive educational element throughout the process to educate them on the process of capitalization and then they can raise money to make their dreams come true. And the third thing is probably to get investors educated enough to understand the importance of investing in early stage businesses and SMEs. Most of us don't know that if you create a portfolio of anywhere between 10 to 20 early stage businesses, you're looking at 27% ROI on a yearly basis. People don't know that. People don't know that that you can actually make, if you hit it right, you can make between 20 to 50 times your money on a business that you invested in. So these are the educational challenges that we see everywhere we go in emerging markets. The general educational challenges is an important one. There are ways and steps where governments can solve these very issues. They tend to be driven by the private companies such as Eureeca, but it's actually not a mandate for us to solve for. And I think Jason here just hit the nail on the head, but these are mandates, these are important things that governments and the public sector should deal with. I think this is something that should land on their desks, and that's where Jason helps different governments and different central bankers and regulators regulate the space.
The comment about regulators is particularly relevant. I think that 3 out of 4 of our panelists work closely with regulators around the world to advance regulations. Nonetheless, the fact remains that both for crowdfunding and for things like mobile money, the majority of regulators around the world, I think, we can probably agree, behind the curve. Sam, you come from the financial industry, as do many regulatory officials. What would you describe as sort of the general attitude towards mobile money and crowdfunding? It's sort of variably perceived as a threat, a positive force, but how are people approaching this, and what needs to change?
Right. There's 2 types, to be honest. I mean, I used to be an investment banker myself, and 4 years ago I quit my full-time job to start Eureeca. I always knew that, or always had the sense back then, that this innovative tool is it should take off, because it just, for the sake of transparency, back to Jason's point, it should take off. It's more transparent, it's more democratic, it just makes sense. And right now, fast forward 4 years later, there are 2 types of reactions. There are some guys that actually can't believe the fact that this is going to disrupt the world of venture capital and investment banking. They can't believe, they're in denial, I suspect. What they don't know is that probably 1 or 2 equity crowdfunding platforms are going to be given IPO licenses this year in the UK, believe it or not, and it started always there. So equity crowdfunding platforms, fast forward a year from now, will be able to conduct IPOs. And I read an article the other day that venture capitalists are really worried in the UK in particular, because it's a very mature market when it comes to equity crowdfunding, because businesses are tending to go to, or businesses are expanding, are tending to go to equity crowdfunding platforms to share the success with their fans, with their customers, and to get a much better rate or much better terms than venture capitalists offer them when they invest in them. So this is absolutely disruptive, it's coming, but the guys that are going to succeed in this space, or the venture capitalists or the investment banks that are going to succeed in this space, are the ones that are finding ways to work with equity crowdfunding platforms as opposed to oppose them.
Mm-hmm.
I mean, the thing that venture capitalists spend most of their time on is trying to find good deals. And what crowdfunding does is it exposes a larger number of interesting deals in a much more efficient way. Because today, you have to meet with every company, have coffee and lunch and dinner and breakfast with people all day long. Whereas if you are able to, what we see, obviously I want to be careful to differentiate securities-based crowdfunding, equity and debt, from things like Kickstarter, which is sort of product pre-purchase, very different opportunities. But this collaborative approach, this hybridization of finance that I believe we're going to see, we're already seeing in a number of markets. So for example, a friend of mine is a hardware venture capitalist, and he spends his morning over his first cup of coffee looking through Kickstarter for companies that have gotten funding for their hardware startups, who he can then look to say, okay, you were successful at selling your product online, so you have a customer for this product. Now you're more interesting to me to invest in potentially as a company who can expand. So we're also seeing angel groups beginning to say, who look at individual angel investors who might look at a company or an entrepreneur and say, that's really interesting. It would be interesting to see, have you go and raise money through crowdfunding first, just a small amount of money to demonstrate you have a community of people behind you, and then come back and talk to me about execution and how you're doing your business. So I mean, there are a lot of examples of how there are two ways to approach this market, and I think that the market, banks, other investors, and commercial banks can look at this as a positive development, as a way to generate more customers, more bankable customers, or it can look at it as a threat. And I think that in most cases, you look at the internet and look at every industry that has come into contact with the internet, and ask yourself, have those industries won or lost by fighting the internet? I think if you embrace the web and the power it has, and create products and services that help you succeed with the web, you will succeed. For those companies that have fought against the web, they tend to lose.
Absolutely.
Yes, so you asked a question about the attitude and openness of the regulators.
Certainly.
And I think we are seeing a genuine shift in attitude, especially amongst developing and emerging country regulators, where less than half of the population may be currently accessing financial services, and something definitely needs to change to realize the full economic potential of those countries. Within AFI in 2011, our members adopted what's known as the Maya Declaration, and that's a 5-pillar commitment, but the very first pillar is to enact an enabling regulatory environment that embraces innovation, and that's a mandatory requirement that all members of the network have to sign up to. And I think as we track results, we are seeing very clear progress. 2/3 of our members have now issued e-money regulations that enable non-bank e-money issuers. About 85% of the members have issued agent banking guidelines. And these are having impact in a number of cases in dramatic increases in the percentage of the population that has access. When we look at something like crowdfunding, it's a little different. This is something very new. It has emerged in the larger of our members, China, Brazil, for example, to some extent. Not yet in many of the less developed countries. It's definitely an area that our members would like to learn more about, and to find the right proportionate regulatory approach. And I'm sure that's something we can involve these two gentlemen in that discussion. As AFI, we're trying to facilitate greater quality of public-private dialogue on issues like this, so that regulators who can be really overwhelmed at times by the technological advances that they have to keep abreast of alongside the day-to-day mandate of financial stability. So if we can find ways through quality dialogue with the private sector to get those regulations in place, then I think everyone will win.
Right.
I'll just add a couple of comments, and I'll start off by saying that, you know, I echo the comments made earlier by my fellow panelists, and in responding to anyone who's sort of fearful of technology or who views it as a threat. I think technology and digital and finance is definitely here to stay. That's what all the trends indicate, and that's the way to go. And I mean, it's hard to beat the value that tech brings in reducing costs, in increasing the speed, in disrupting this and dismantling this barrier of distance. You know, and all these points are hugely relevant for the low-income segment, because that's what makes them so unbankable, because the commercial banks don't want to go down to the remote areas where these people live. It's too expensive to lend to them, because the amounts that they borrow, you know, just don't make a lot of sense. And it's really expensive to also maintain these brick and mortar branches that you would need to in remote places. So I think what technology offers is it helps us to overcome these three barriers in a very significant way. And you know, and that's not to say that technology is sort of it's part of the answer. So when you're addressing the needs of this customer segment, because ultimately, you know, in banking, trust is still a fundamental value, and for that trust to be established, that human connection, that human touch is also very valuable. So I think it's going to be a mix of the two, particularly for this segment that you're talking about, where you know, the poor don't necessarily always have the most agency to kind of demand for products and services, and they're also not the most aware about what is being offered and what is formal and what is regulated. So I think it will be a combination of technology as well as, understanding the needs of people and positioning the value of digital solutions in the minds of low-income customers. So it'll be a combination of two.
I want to change gears here for a moment. His Royal Highness came and gave a wonderful speech this morning, and he specifically pointed towards the poorest members of society and talked about how the financial industry at large is mostly pointed at people with money. These technologies have an incredible potential to be disruptive to that model and to pull in the vast proportion of the population that doesn't fit into the global definition of middle income or above. For crowdfunding and for other types of financial technology, maybe you all can address what benefits do these technologies have, not for the industry, not for financial professionals and companies, but for the relatively poor or the poor who will use them.
Right. Never in our lives we had an opportunity to invest in early stage and growing businesses like the way we are capable of doing so right now using equity crowdfunding platforms. I mean, if I knew about Facebook raising money 10 years ago, I would have definitely participated in that. And I could have participated in that with $500, with $1,000, or $100,000. So what equity crowdfunding platforms do is democratize the process of investment, low barriers to entry, allows people like you and myself to participate in creating wealth for ourselves. This is not just for the wealthy and the expert financial sector, but also for the normal man on the street. That's one thing and one side of it. But it also allows, what equity crowdfunding does, it also allows, I don't know if you know this, but 50% of the female population around the world, the female population or female entrepreneurs find it extremely hard to raise money. They're actually 1/3 likely to raise money when compared to the male entrepreneurs, and equity crowdfunding platforms open up that and unlock that opportunity for female population. At Eureeca itself, 60% of the entrepreneurs that raise money are female entrepreneurs, and we're proud of that number. But these are the sort of things that would impact, would impact positively on an economy.
I think crowdfunding is going to, the first impact it will have is, just frankly speaking, on the middle class in the country, and the opportunity to move wealth creation out of just the realm of the top 1% of a country and into the broader middle class, which then drives additional benefits and expands those markets into the lower income segments of that market. So I think it sort of will happen over time. I think the other thing it does is these tools that we need to have for additional financial inclusion and utilization for the poor, they come when more entrepreneurs have access to capital to create those solutions. That happens through equity crowdfunding. That happens through because they will solve these challenges. One of the big challenges, obviously, is how do you create a credit score in an environment where there are no credit scores? And what we're seeing is in countries where they have either peer-to-peer loans, peer-to-business loans, equity crowdfunding, there's a requirement for the industry to create those solutions. So we're no longer waiting for Dun & Bradstreet or other global organizations who FICO scores, those sorts of things, to hopefully one day come to our country. It's the opportunity for innovators are creating their own algorithms to say, how will the cell phone payment rates and my cell phone utilization, meaning what time of day and how do I use my phone, how do those impact repayment rates on loans? And creating very viable algorithms that now are used to underwrite loans in a number of markets very successfully. So that then opens up opportunities for more people to access credit. And so I think that there's a tremendous opportunity for this to help those poor segments. my opinion, it's sort of a two-step process, but it's important we take the first step to get to the second step.
Let's put the first question up on the screen. That is, does crowdfunding contribute to greater financial inclusion of the low-income population, or is it just a product that supports SMEs? We've talked a bit about what we think. Let's see what you all think. In the meantime, I want to put a related question over to our Jason and Isvary and Robin, our two sort of experts on policy. We've talked about crowdfunding and the ways that it has the potential to sort of increase financial inclusion and also to help the poor participate in the financial system. What other technologies do you all think are most important in that process, if you had to pick a couple?
Well, I think I sort of alluded to the fact that mobile money is probably the biggest thing right now when you talk about increasing access of finance, and that's access of finance and use of financial products, and that's really what we mean by financial inclusion. So today what we see is mobile money is used in a really big way, and Kenya is obviously the darling of the mobile money industry. It's largely used for payments. So these are, sort of remittances domestically. But when we talk about and when we strive towards real financial inclusion, that really means that we are also striving to increase the social mobility of people through their access to finance. So this would mean that we provide them with a larger suite of products, which includes savings, which includes insurance, as well as credit. And credit is largely dominated by the microfinance sector for low-income populations. A lot of these guys are also transitioning to digital platforms. So I think there's still some way to go before you see the links between how technology really impacts financial inclusion from the holistic perspective and how it impacts actually increasing a poor person's social mobility and hence addressing this issue of poverty, which is fundamentally what we're all concerned with in the development sector.
Certainly. Can we see the results on the screen, please? So most people think yes. A significant number of people think that yes, but it's not designed to promote financial inclusion. And others think no, but we need some modification. We're sort of running out of time, so I wanted to direct us to something that we had discussed beforehand, and that's come up several times today, primarily in sort of the opening speech, which is transparency. Technology has the potential to increase transparency depending on how it's implemented. And in some economies around the world, a lack of transparency and corruption has arguably sort of decreased opportunities for a large proportion of the population. Do you all have any comments on the future of financial technology and the financial sector in terms of transparency?
I think crowdfunding promotes a level of transparency that's never been available before in the private capital markets. I think that it is a tool that will provide, because then that transparency will then begin to move into other parts of the private capital market. So the central thesis of my work is that crowdfunding is this newest part of the private capital markets. And there's a great deal of innovation that is taking place today in crowdfunding and creating access to capital. And many of the tools and services that will be created in this crowdfunding ecosystem will begin to be used in the rest of the private capital markets. We're already seeing that happen. And so that will drive investors, because if you are an investor in a crowdfunding platform like Sam's, and you're able to interact with the companies that you invest in, and you have a level of visibility into what's happening with your investments that you don't have in a venture capital fund or in a private equity group or in an angel investing group, all of a sudden you have a greater expectation of visibility. And so that will drive, I think, those investors to demand more visibility and accountability on their investments in their these other traditional means. So I think it's a good thing ultimately for all investors.
Yeah, I think we can see clearly that there's nothing less transparent and provides more opportunities for corruption than a cash-based economy. So
Absolutely.
anything we can do to shift the balance there will help. And I think that's one of the reasons that many governments are attracted to electronic payment solutions. We have seen a number of countries now that have been successful in shifting government benefits and even government salary payments as well to electronic accounts, and the early signs are that has quite significant results in cutting out at least a component of the corruption that maybe exists in other systems. We've also seen now possibilities for aid agencies like the World Food Programme to deliver emergency aid directly to people through mobile money solutions onto their mobile phone, which again cuts out a lot of middle agents. So I think there should be quite a clear alliance of agendas between anti-corruption and the fintech and regulatory communities.
Excellent. I'd like to open up just quickly the floor to questions. If anyone wants to throw us a curveball, please do so. Yes, sir.
Thank you. My question is regarding the introduction of technology. I could agree that it is very easy that it increase the financing for those who do not have access to financial services. But my question is there any work done to find correlation between the rate of saving and the rate of introduction of technology?
So does the introduction of technology promote savings?
I'll try to respond to that question. So I think, as I pointed out earlier, when you look at products which are financial products which are being offered, and this is, I would say to a low-income segment again, a lot of them are focused on payments and airtime top-up, and so effectively in the payments realm. In Kenya now they've started Mshwari, which is a savings product. And there's also an insurance product called Freemium, which is tied to opening an e-wallet account. So I don't think that the mobile money industry has evolved to a stage where there is enough data on the relationship between technology and how that actually increases savings. And my guess would be that it's not only technology and the fact that you're now using a technology platform that will impact things. A lot of different factors will come into play as well as to how to increase the adoption or savings in any market.
Yes, I think I would agree with that. I don't think we have the macroeconomic evidence on that yet, but we are seeing signs that the mobile phone as a device is making it easier and simpler for people to save. In the Mshwari case in Kenya, we have more than 12 million people regularly saving through that product over a relatively small period of time. Even where there is not a formal savings product, you still see people saving informally on the mobile phone by leaving a balance there. So you can deduce from that behavior that there is potential and that there is a need to be met for a safe place for poor people to save.
Any other questions? I have a question of my own. Because we're talking about technology, this discussion may be irrelevant in 5 years because of the rate that technological development proceeds. And in all of the markets where these panelists work, and probably where most of you live, smartphone penetration has been going up at an incredible rate for several years now. What do you all see as the future of your respective fields? Financial inclusion, crowdfunding, and peer-to-peer lending. Will there be some sort of convergence once there is wide access to mobile money? Will this change the way that we think about markets as a whole? That includes, equity markets, debt markets, and venture capital, as well as just the process of buying something normal in a day-to-day setting.
Right, okay. We are weeks away from you walking into your favorite restaurant that you go to every weekend and you come to pay the bill, and you'll be told by the waiter, by the way, you can invest in this business if you want, because we're opening up a second branch somewhere else. And you'll be able to grab your phone, do a couple of swipes, and invest in the business any amount that you like to invest in, and own shares in that business. We're literally weeks away from doing this. And again, back to your point, fast forward 2-3 years from now, this will be absolutely normal. Right now, it's strange to hear it, but it'll be absolutely normal.
Yeah, I think if 5 years ago, most of us would have been told that, there's this new service, you can get in the backseat of a stranger's car and they'll take you to a place that you tell them and then you'll pay with your credit card. Won't that be great? You'd say, there's no way I'll do that. And I mean, most of us have used Grab or Uber or something like that in our lives now. I think it's pretty normal and works pretty well. So things are unusual and new until they're not. And in 5 years, we will not talk about crowdfunding anymore. We'll just talk about funding. It's just one of the ways you raise money for a business. It'll be very, very commonplace. This takes a common practice that's happened for millennia of friends and family and people who know each other and communities coming together to fund businesses informally and makes it a formal process. And so this has a huge opportunity, but I think that it will become very, very commonplace and seem very normal in the very near future.
Yeah, what about from a financial inclusion perspective?
Sure, yeah, a couple of things. I think one trend is clearly that we're seeing a growing convergence in digital financial services and more partnerships and cooperation between banks and telcos. So I think we're going to move away a little bit from the bank-led versus non-bank model and more towards seeing innovative partnerships that meet the needs of particular markets. I think another area where technology really needs to come in and make a difference is cross-border remittances, because if you look at the pricing here, it's remained stubbornly high over a long period of time, and to pay 10% of a $200 remittance is really quite significant when you're dealing with people on very low incomes. And I think that's an area that fintech companies can come in and find solutions, but they have to work together with regulators in many different jurisdictions to do it. So I would predict that in 5 years, if that effort is successful, we should have dramatically lower cost of cross-border payments than we do now.
That's fair.
So some of the things that I'm most excited about is I think there's a huge potential to see a larger number of products, financial products and services being offered on a digital platform. So just moving away from solely payments, starting to also offer credit and savings products. Credit is still largely dominated by the microfinance sector for the low-income population. And the other thing which Jason has already mentioned is that there's so much data that sits at the back of every transaction that you do on a digital platform. And for the low-income segment in particular, this was data that we never had and people weren't particularly interested in for a long time. So now it's going to be a lot easier to access this data and to also build credit scoring models. We've seen that with Ali Finance. So all that's very encouraging, and I'm as an organization, I think MicroSave is also very excited about the possibility to bring a lot of things and the impact of technology that we're seeing in more developed markets, downstream that to serve the lower income populations as well. And that's what we're doing with institutions that work with these segments.
Just real quick, diaspora populations and the engagement there. One of the things we're commonly asked about is crowdfunding with diaspora populations and how do we layer on top of remittances investment. One of the things that we've seen, we've done some research for the World Bank on developing country context crowdfunding that's available. And also there's work that's been done on this diaspora investment, and not in Asia or in Africa, but in actually the Caribbean context. My belief is that kind of crowdfunding and diaspora engagement will occur once you have some meaningful initial activity in the home country itself. When there's a demonstration that the investments can take place in the home country, that is a market that works, you can then begin to access those diaspora populations for these investment capital.
Excellent. There you have it. It's a rapidly changing world. Before we go, I want to have the final question up on the screen. What is the single most significant impediment to leveraging technology to broaden the base in emerging markets? So what is the barrier to that change that we've just discussed? I'd like to thank all of our panelists. You all can answer this question, and I'll invite the next panel to the stage.